This master limited partnership has increased its dividends for 20 consecutive years. But even better, you can buy this stock with almost an 8.87% dividend yield, and it's currently significantly undervalued. Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. I want to welcome you once again to a subscriber request Tuesday, where I've been asked to cover several REITs as well as MLPs, in other words, high-yielding stocks. And I like high-yielding stocks, but I use them discriminately, and I use them to meet specific investment objectives, and I think that's the key. No matter what kind of investment you're making, you ought to always do it with your eyes wide open. So my goal here is to open your eyes on what I consider to be 7 very attractively valued, high-yield, dividend growth stocks in the form of REITs and MLPs. So let's go ahead and get started. Let's look at the portfolio. I've got 7 names I'm going to be covering. Energy Product Partners, which is oil and gas transportation. This does come with a K1. It's a master limited partnership. I'll be looking at Magellan, Midstream Partners, another limited partnership, oil and gas storage. I'll be looking at Medical Properties Trust, which is a healthcare REIT, National Retail Property Trust, which is a retail REIT, another healthcare REIT, and Omega Healthcare Investors, Store Capital, which is a diversified REIT, and VC Properties, which is a specialized REIT. It's actually considered an experiential REIT. So let's go ahead and look at these one at a time. Let's start with Enterprise Products Partners, and I'm going to automatically go to operating cash flow. As those of you who are FastGraph subscribers, when you're looking at high-yield stocks like MLPs and REITs, I always suggest that you look at them through the lens of operating cash flow, because these investments are primarily about the dividend yield. And here you've got a long-term look at the company. You can see that the operating cash flow, at least for the last more than a decade, has covered the company's dividend distribution, which is the white line in this graph. This MLP offers a 7.82% dividend yield, and it has a very good record of growing their dividend over time. The average growth rate has been about 5.8%, but I do want you to note that growth for the last 5 or 6 years has dropped down, well, the last 3 years to about 1.6%. For the last 5 years or so, it's about 2.5%. And that's a sign of the times. But energy prices are rising again, and so there very well could be an opportunity here to buy these stocks. And of course, they're trading at very low discounts. 7.82% dividend yield. The company's BBB plus rated, which is a very high rating for a master limited partnership. Does come with a K1, so that's something that you need to be aware of. The next one I want to cover is the one that I featured in the intro, which is Magellan Midstream Partners, which again is another oil and gas storage. Here we've got an 8.87% yield, 20 consecutive years of dividend increases. Now again, I want you to have your eyes wide open. Dividend increases for the last couple of years have been rather meager, but they have kept their streak alive, and they're kind of committed to that because, as you see in their investor presentation, they have promoted that. You know, one thing as a FastGraph subscriber, you can always go into the external links and go to the corporate website and learn about what the company does, what they do, who they are. You can go into investors and get information on tax info. You can go in and get webcasts and presentations where you can look at the companies, you know, and see what the business itself is all about. Management give you guidance when you go into things like that. So that's something that can be very, very useful. The next one I'm going to take a look at is Medical Properties Trust, which is a healthcare real estate investment trust. Again, the company's had very good growth since coming out of the Great Recession. We'll go ahead and shorten the time frame here so you can see that it's been growing at about 6.5% a year. Has a 5.58% dividend yield. And the company has a really good record of increasing its dividend at about, a 2 or 3% rate since 2013. So it's got high yield. And again, the reason for using investments like this is not necessarily for capital gains and performance. You can use these to sort of turbocharge an income portfolio where you can get some extra income or boost the overall yield of your portfolio by sprinkling in some of these REITs and MLPs. I do consider them slightly more risky than you would have, looking at blue chips like, say, for example, Procter & Gamble or Johnson & Johnson, but it's very attractively valued. Dividend yield 5.58%. You can buy it for a price to funds from operations, which is how you want to evaluate REITs, at under 12. That gives it a FFO yield of 8.5%. I consider this one very attractive and would be a really good buy. Looking for the future here. Demographics play is what you're looking at. National retail properties, in an inflationary environment, interest rates could be rising. That could be problematic for certain REITs. But on the other hand, with inflation, especially a retail property, they get it, you might see price increases and therefore their dividend coverage, real good. Performance-wise, the company has, increased their dividend in most years since 2001. Growth rate's about 2.5%. So it's not a real fast dividend income grower, but it does give you almost a 5% yield, 4.92% yield. And is trading at an attractive valuation. Not a whole lot of margin of safety here, but it's certainly inexpensive relative to a lot of stocks out there in the marketplace. The next one we're going to look at is Omega, another healthcare REIT. Omega's had some problems during COVID with a couple of properties, but they've begun collecting their rents again. The company's earnings are doing good. They're expected to have a down year this year, which I think explains the really low valuation, and I think the risk of investing in this particular healthcare REIT today is relatively low because of the fact that you can buy it at such an attractive valuation, one of the lowest valuations I've ever seen this particular REIT trade at. It offers almost a 10% yield, 9.42% dividend yield. They have froze their dividend, but they did pay and continue to pay the dividend, and things are starting to improve, and they're expected to improve very nicely starting in 2023 and 2024. So this would be one, again, that's a great valuation play. It has, it's BBB minus, it's investment grade credit rating, offers a 9.4% dividend yield as of yesterday's close, and it has an FFO yield of almost 11%. I consider that very, very attractive as far as REITs go. Store capital. Now, these last two that I'm going to be featuring here just in the basic fast graph, I also want to give you some insights in how to use this dynamic tool. Because what you see here is a growth rate that's essentially contaminated by an extremely aberrant high growth rate in the first year. This company is, relatively new. So the first thing you want to do is you want to get rid of this anomalous dividend growth rate, because if you look at performance here, the dividend growth rate has grown by 44% a year. But that's clearly an anomalous. And again, it's being skewed by the fact that we have, had a rather high dividend yield the first time. So we want to cut that out and try to look and see what would be considered more normal. We get about a 6% dividend growth rate, but it has been slowing ever so slightly. Store capital is an interesting REIT. You can, again, use your fast graphs, go into the company's website, and you can look at, what the company does. They're the leader in middle market real estate capital solutions. And, in this website, you can learn a lot about the company. So I encourage you to do your own research. But once again, I think we have an attractive valuation. You can see the best time to have bought this, since it went public would have been during COVID. You'd be greedy when others are fearful and fearful when others are greedy. But the stock is reasonably valued, offers almost a 5% dividend yield, FFO yield of 6.7%. It's BBB rated. So again, we got another really high quality REIT here, but I want you to know that this is a tool to think with if you're using fast graphs. So make sure that you look for things like anomalous numbers. And we're going to see that very clearly with this next one. This is an experiential REIT, and I'll talk a little bit more about that here in a moment. But the key is, when you first looked at this went public, you get some really crazy numbers, a 2,600%, growth rates in these first couple of years. But that's just the company forming itself and becoming public. So once again, you want to call out those bad numbers and see what's normal. Now, we only have 3 years of history here, but we've got a REIT that's growing at about 7.28%. It's forecast to grow at about the same rate going forward. Long-term growth rate is 6%. So it's, all within reason of these same numbers here. This company owns Caesar's Palace. For one, it's an experiential REIT. They're, in gaming and other things that, we'll call it entertainment. Very attractive. Recently went public. You can buy this stock at a 5.13% yield, 6.5% FFO yield. So again, you would use these, and companies like this, especially when they're attractively valued like these are, in order to kind of turbocharge the yield on your portfolio. I use these sparingly myself when I construct portfolios where, I have a client that's looking for more yield than the market could give. I think the sweet spot right now is 2.5 to 3.5%. In my last video, I covered some dividend growth stocks that were attractively valued that sat in that, what I call sweet spot of yield. These are for high yield, a little higher risk. You're going to give up a little bit of growth and give up a little bit of growth in the dividend as well. They don't grow their dividend very fast, although BC Properties has had their dividend growth be over 11%, but again, a very short history. Now, the last thing I want to go over with each of these 7 companies is I want to go to fund graphs. And I want you to see something that I think is very, very important when you're looking at MLPs and REITs especially. They have a tendency to be raising capital because of their capital needs. They're either buying, building new pipelines, adding new assets. In the REITs, they're, buying new real estate, adding new real estate. So they're diluting their shareholders quite a bit. Enterprise has, diluted on average about 11% going back to 2000. But if you look at the last, 10 years or so, we'll shorten that to 9 years. They've only been diluting shareholders by about 3%, but there has been some minor dilution. So you see that with Enterprise Partners. Magellan is one of the few that have not really had much dilution. They've actually been buying back shares and paying a nice dividend, if you recall. But, over time, there are times when the company does issue shares when they need them. So a lot of companies are self-financing today. MMP is probably doing as good a job of that as any of them. Medical Properties Trust, which is a classic REIT, which is constantly issuing new shares, but they're also getting, significant revenue increases, and they're supporting their dividend growth and so on. All of these companies are doing that, but keep in mind they are dilutive. They do issue new shares constantly. National Retail Properties, another REIT that basically is diluting shareholders continuously. Omega Health Ventures is constantly issuing shares, raising capital, to grow their business. And, if you go into their website, they've made some acquisitions and they've done some capital improvements recently, as an example. Store Capital, they've been dilutive. You can see they've increased their share count. BC Properties is relatively new, but they've been increasing their share count here in recent years. So there you have it. You have this portfolio of what I would call high yield REITs. The dividend yield starts from as low as 4.9, almost 5%, all the way up to 9.42% with Omega Healthcare. These are all REITs that I think are attractively valued today. You can utilize them to, again, turbocharge an income portfolio if you're, discriminate with them. They've all got decent credit ratings for REITs and MLPs. That's, there's only 1 or 2, for example, REITs that even get into the A category. So keep that in mind. There is some risk, and I think a lot of that has to do with the dilution that I showed you. But anyway, they're all reasonably valued. They have good, attractive yields, and there's something that you can research a little more on your own and possibly add to your portfolios. Anyway, this has been Chuck Carnival taking another Investor Request Tuesday look at MLPs and REITs, some select ones that I feel are good quality REITs and attractively valued with good futures. I think they're well positioned from a valuation point of view in this rising interest rate market and inflationary economy that we're currently in. So that's something you might want to take into consideration. If you like the video, give me a like, ring the bell, subscribe to the channel. We'll be covering much more here in the future. I got some surprises to show you here in some upcoming videos. So anyway, thanks for watching. I appreciate you as always.